Hi, good afternoon. Welcome to my class, Corporate Finance, and very happy to see you. Due to the very special situation that we cannot make the teaching live, so I pre-record this video, and hopefully this video can be clear and convey the most important information that I want you to learn. So this course is called Corporate Finance. So we want to learn everything about financing and investment about corporations. But before we learn corporate finance, we want to learn what finance is. So in the first class, let me give you an overview of finance. So my name is Wang Zigan. I'm a PhD from Columbia, graduate from Columbia in 2015 and joined the HKU after that. So let's start. So how do we understand finance? Finance, in essence, is a very special discipline, a sub-discipline of economics. And what is economics? All of you, or most of you, are from the business school, so I think you have some preliminary information, knowledge about economics. Everything about economics is to study how to allocate limited resource to maximize utility. You must be very familiar with this term, utility. And utility is basically happiness, people's demands. You have a utility function because you have multiple directions, multiple aspects of your life to be happy with. You want to have food, you want to have entertainment, you want to receive education, you want to love everything. So how do you allocate your limited resources such as time, money, and other resources to maximize your utility is a topic that economics studies. As a sub-discipline of economics, finance is also about allocating limited resource, financial resource, to maximize the corporate utility. What is a financial resource? In essence, it's money. It's money. And what is a corporate utility? Well, this is tricky because in different countries, in different cultures, we have different definition. In Anglo-Saxon culture, or in the British or American, also in Hong Kong culture, it's all about maximizing corporate profits. While in some other cultures, such as in Japan or Germany, the corporate utility includes other things. I call it welfare, but it's probably not very accurate. It's more about the stakeholders' interest. The corporate profit is about the shareholders' interest, the interest of the owners of these corporations. While the stakeholders' interest includes also the employees' interest, the customers' interest, the society, the interest of everyone that is related to this corporation. So in Germany and in Japan, they have some laws to regulate that you have to have some female members in your board. You have to have some specific laws to protect your employees. So in their corporate finance, they allocate limited resource, their money, to maximize not only the shareholders' utility, but also the stakeholders' utility. Remember, shareholder is a subset of stakeholder. Stakeholder includes the shareholder, the employees, the customers, the regulators, everyone who's related with the corporations. Economics. The allocation of the resources includes supply and demand of this resource. And the supply and demand, this is Marshall's thesis, generates what? Generates a quantity and price in equilibrium. While in finance, the supply and demand of the financial resource, which is money, generates the money supply and the price of money. What is the price of money? Well, in normal class, I will just ask you and ask maybe some students to give me some answers, and we have some discussion, because for now I'm pre-recording this video. I will just directly tell you the answer that I have. The price of money is interest rates. Remember, the interest rate is as essential as a core position of the whole finance. Why is interest rate the price of money? Because interest rate is basically the exchange rate of money in different time. If you have $1, let's say $1 million today, and $1 million in 10 years, which is more valuable? Of course, $1 million today, because you can save the $1 million into the bank. Then the $1 million will generate interest benefits in 10 years. So you actually have more than $1 million in 10 years. So compared to $1 million in 10 years, we prefer $1 million today. That is to say that $1 million today is more valuable than $1 million in 10 years. Okay? So they have different value. The same amount of money have different value just because they're given in different time. So let me ask you another question. In exchange for $1 million today, to give up $1 million today, how much money would you want in 10 years? $1.2 million, $1.5 million, or $2 million, or $10 million? The answer depends. Depends on a lot of conditions. If you are in Zimbabwe, you know that Zimbabwe used to, the government used to experience hyperinflation, and they, if I remember right, they print out the $1 trillion. You know, if you wait for, in Zimbabwe, you wait for 10 years, then your $1 million will be, the value of $1 million today will be almost zero in 10 years. So you probably will want to have 100 million trillion dollars in 10 years. In the US, you probably only want maybe, let me guess, $1.3 million. So the additional amount of money is the component of the exchange rate. You have the exchange rate between the money today and the money in the future, the financial resource today and the financial resource in the future. And this exchange rate is the interest rate. Interest rate is linking the money, the value of money in different time. We say present value and future value of money. But then there is another question. What determines the interest rates? Yes, interest rate is determined by the supply and demand of money. In the risk-free world, the ideal risk-free world, if the government is printing, if the Federal Reserve in the U.S. is printing, or the central bank, the People's Bank of China in mainland China, if they are printing a lot of money, then of course the supply of money is huge. If the demand of money is fixed, then the interest rate will go down. Okay. In a risk-free world, interest rate is determined by the supply and demand of money. But we are not in the world free of risk. So the interest rate is also determined by another factor, risk, which is also important. Remember, risk, here the risk is about uncertainty. A lot of people, I would say like 90% of people in the world have some sort of misunderstanding of the risk. Risk is about uncertainty, unknown things about the future. And remember, the risk is about the uncertainty that everyone has in the world. For example, Will there be an alien invasion in 10 years? Nobody knows. Well, I think the uncertainty is really low. But think about the COVID-19. Will the COVID-19 in North America and Europe be more severe? Or they will be controlled substantially in 2 months? Who knows? Well, I don't know. Probably the leaders. I think the leaders, the European countries in North America, they also don't know. So nobody knows it. That is uncertainty. If something is that other people knows, but you just don't know, that is not risk. This is ignorance. Remember, ignorance is not risk. Okay? If there are some things that nobody knows about the future, that nobody knows today, this is called risk. Because of the risk, the value in equilibrium about the money is different. For example, in Zimbabwe, the risk, the uncertainty about how much money the government will print is very high. So people demand a high interest rate if you want them to give up the present value of money. If you want them to give up $1 million a day in exchange for the future, future amount of money. But in the U.S., because about a lot of regulations, it's very unlikely that the U.S. government will print the money without being controlled. So in that system, the risk is relatively low. If you lend money to a government, that is to buy the treasury bond of the government. That is, you buy the bond from the government. We haven't learned bond yet, but the bond is basically a borrow-lending contract. You lend the money to the government. If that government is Greek government, you think the risk is high because Greek government has a very, I wouldn't say very bad, but yes, let's admit this. About over 40% of time, Greek government refused to. They were unable to pay back the money that they borrow. So the risk is pretty high. And for some governments, we don't even know in 20 years if the government will still exist. Then the risk is very high. The U.S. Treasury bonds interest rate is really low. It's the lowest in the world because people believe, the market players, investors believe that the U.S. government is the safest government so far in the world. It's unlikely that the U.S. government will fall apart in 10 years or in 20 years. So they will give my money back, and we require lower interest rates. About risk, I would say, is the number one factor, is really, really important, is the most important factor in finance. Because risk is about uncertainty. It's all about information asymmetry. It's about information asymmetry between you and me, between now and the future. Everything that we don't know. Okay? And this is related to the importance of finance. Why financial system is useful. Some people say that finance, especially in 12 years back, in 2008 financial crisis, during that time, I heard a lot of people saying, well, the bankers, the finance people, they're just fraudsters, and they're basically running the casinos. Okay, they're cheating others' money, something like that. This is not true. In any developed countries, developed economies, finance is very, very important. Because existence of finance is to minimize the information asymmetry. In finance, there is primary market and secondary market. The primary market is to make the real asset into financial assets. Financial assets are all about contracts. Real assets are like, for example, this computer, this hotel, this whole building, um, this cell phone, or even this cup. All of these, they are the real asset. But how do we know the real value of this asset? Well, it's probably easy for us to know the market value of this phone, but it's not really easy to know the market value of a company. If you see a company has like say 2,000 people, 2,000 employees, they're doing things, and they're generating some sales. Of course, they have some costs, salary costs, other costs, so they generate the profits. If you think about this company as a black box, you will see the sales gets money in, and the cost takes money out. And this black box will give you some sort of balance, and this balance is a profit. If you think about this company as a financial asset, then it is financial asset that will give you some profit every year. This year it gives you $10 million. Next year it gives you $12 million. Then next year it gives you $15 million. Then next year COVID-19 happened. Then it only gives you like $1 million. Then next year COVID-19 continues. So it goes bankrupt. How do we know the real value of this company? How do we expect the future profit or the sales and cost that this company will give you in the future? Not easy, not easy. You cannot just interview 2,000 employees in this company. So for investors, if you want to buy this company, how do you buy it? $1 billion? $2 billion? It's really difficult. And as a small investor, I don't have $2 billion. I only have $500,000. Can I buy a small part of this company? And I will only have that part of profit distributed to me in the future. Can I do that? Without finance, without corporate finance, the whole financial industry, this will be impossible. Corporate finance, the whole development of corporate finance, or the introduction of the Western corporate finance system into mainland China really helped the restructuring of the state-owned enterprises in 1990s and 2000, in the 2000 in mainland China, and in a lot of other countries. You cannot just buy the whole company because a company is an organization. To evaluate the value of the organization, you need some experts to evaluate this value. And these experts are called investment bankers. What do they do? Investment bankers, his name is really, really fancy, but what they really do is has a lot of very tedious components. For example, a lot of my friends are working in the big investment banks. I ask them, what do you do? They say, we fly a lot. So you fly 100 times a year for what? So basically this company claims that they have a factory in some remote mountainous area. So we have to really fly to that mountainous area to check whether this factory really exists. And we really have to check whether this factory really belongs to this company. Well, there were some frauds. For example, one Chinese company listed in Toronto Stock Exchange proven to be a fraud. That company claimed that a vast land and forests are their assets. but actually they were not. They just forged all of these documents. So these documents are not real. But the investment bankers, they fail to recognize this, and they just say, okay, we can underwrite this company. So this company really had a lot of assets. So the value of this company is really high. Then the investors put money into this company, and they suffer loss. Of course, these investment bankers will also have some punishment to them. So this is the primary market. To turn the real asset, for example, organization structure or forest assets, factories, you turn them into some contract. You first give them a total valuation, then you divide this valuation into, say, 1 million or 1 billion shares. This is why we call stocks. You know, the companies, everything together, it's a stock. It's a stock of things. And you divide them into different shares. So you buy the company's shares. Okay, you buy their shares. This is a primary market. You turn the real asset into the primary into the financial assets, a lot of contracts. And you ask the investors to use money, financial resource, money, to buy this. The secondary market is the sell and buy of these financial assets. Because probably I think this company is worth $1 billion. So I bought the shares. But now I think, well, I don't know. I think this company is only worth $500 million. I don't think the stocks, the shares that I'm holding is that valuable. So I want to sell them. But the other person, the buyer of these stocks, he knows some special information. He knows that although this company is not performing very well financially, but they are really making a big progress. They are close to have the vaccine of COVID-19. But you just don't know it. So I know that this company's value will be $10 billion. If you don't want to hold this company's stocks, just sell it to me. I want to buy it. So this current holder says, okay, I think it's only worth $500 million. Let me sell the stocks at $1 billion and see some stupid guys will buy them. And the other buyer said, like, what a stupid guy selling this stock for only $1 billion. It's actually worth $10 billion. Let me buy it. If more and more people know that this company has some special achievement, more and more people will buy these stocks. And the higher demand of stocks will push up the stock price in the secondary market. Why is this useful? Because as an ordinary person, for example, me, I'm not an insider of this company. I don't know anything about this company. I don't know whether it has any achievement in COVID-19 vaccine. I don't know how it goes. I don't know whether their board, their management team is good or not. If I want to know whether this company is good or not, I only need to look at the stock price. If a lot of people are buying this stock, I know that this company is doing good. If a lot of people are selling this stock and stock price is crashing, I know this company is in trouble. This is not only minimizing the information asymmetry between the ordinary person like me and the company. It also applies to the government. How do you know a government is doing well or not? You look at the government treasury bonds interest rate. We will learn it in maybe 2 weeks. But if one country's government is doing really poorly, for example, it spends a lot of money, but does not really receiving a lot of tax revenue, then this government is close to bankruptcy. Or to avoid this bankruptcy, it probably have to print a lot of money to cause a potential hyperinflation and then become the second Zimbabwe. So how do we know that this government is doing good or not financially? How do we know it? This company, almost every government is issuing the government treasury bond. That means the government is borrowing money. So we only need to look at the interest rate of this bond. If the interest rate of this bond is really high, that means the market investors know that this government is having some trouble. The risk is high, so they demand higher interest rates. The higher interest rate is also reflected by a smaller demand of this government bonds. If the government bond if this government financial condition is very safe, very healthy, then a lot of people want to buy this bond. So the high demand of these bonds will make the interest rate low. But if nobody really wants to loan money to this government, then the interest rate will be high. As an outsider, for example me, if I want to know whether a government of Madagascar or whatever European country, I have no idea about that country. I just need to look at the interest rate of the government bonds. I know how well the government is doing. So the financial market substantially minimizes the information asymmetry. Due to the efforts of a lot of investors, buyers and sellers of the whole financial markets. And they want to do it because they want to be profitable. They want to make money. This is the same as Adam Smith says, your shoemakers make shoes for you, not because they are kind people. It's because they want to make shoes and you buy the shoes and they can make money. These people, they are minimizing information asymmetry. They are helping you to learn things about the world, to learn things about this company or that government. Not because they are kind, just because they want to make money. So, finance is a subdiscipline of economics. It allocates limited resources to maximize the corporate profit, and investors in this whole financial market provide a lot of useful information for the whole world to make the information public, motivated by their profit maximizing motivation. Okay. So this is about the whole financial system. But financial system has a lot of things. For example, we say buyers and sellers of the financial assets. But who buy and who sell the financial assets in the markets? This company or that company? And who are evaluating the risk? And if some market players, they want to play around and spread some misinformation, who can regulate them? This slide, the overview of finance, will tell you. For example, Goldman Sachs, GS, Goldman Sachs, Fed or Federal Reserve, Bridgewater, BCG, Boston Consulting Group, they're all market players in this financial system. But they are doing very different things. They're very different companies. What do they do? And as a student, how do you classify so many financial institutions easily? I'm helping you to be capable to identify what a company is doing in the Hong Kong streets and everywhere in the world, financial center, London or New York, quickly. Sell side. The sell side companies, are called investment banks. Remember that investment banks is a very misleading term. Investment banks are not doing investment, and they're not banks. A better name to call them will be broker-dealer. It is also a name for investment banks, but broker-dealer doesn't sound that fancy, so they still call them investment banks. Investment banks are doing three things. The first thing is to contribute to the primary market. That division of the investment bank is called investment banking. For example, I have, let's say not a company, just this hotel. I have this hotel. The hotel generates revenue. Okay. But one day, I really need some money. I want to have some other business. I think running a hotel is so boring. I want to do big data. But I don't have money. If I just use the profit of this hotel, I would have to spend, say, 20 years to accumulate enough money to open my big data company. So what do? I want to sell the hotel, but I don't want to sell the whole hotel. Because the hotel, I have been running this hotel for 10 years. I've devoted myself into this, and I just want to sell 20% of this. But this is a question. How do you sell 20% of a hotel? How? You cannot just cut the 20% of the hotel rooms and say, hey, these hotels are yours. How about the receptionists? How about the front desk? Can you just cut them into 5 parts and give 1 part to the outside investors? You cannot do that. So how do you do this? This is the same for some other companies. Maybe not a hotel running company. Maybe some other company. For example, a big data company. A big data company wants to run a medical research company. COVID-19 vaccine development. How does a big data company divide their assets into 5 parts? Copy the data for 5 parts, for 5 copies, and give you 1 copy? Or just give you 1/5 of their data? Now what about the people? What about the data scientists? You cut 1 scientist into 5 parts? You cannot do that. So how do you do this? You have to ask the investment banks to help you. The investment banks, they will, like what I said, they evaluate your profit, risk, assets, and everything. Then they create financial assets or contracts. That contract will list all of the assets that you have and their evaluation, professional evaluation. Well, professional evaluation doesn't mean that the evaluation is perfectly correct. None of the evaluations are perfectly correct because there is no correct answer. Okay, but the professionals, they have better evaluation than average ordinary person. It's because they have seen so many financial assets. So they give you the price, they propose the market price of these assets. Also the goodwill, the reputation, they are also all your assets. And also the brand names, the value of the brand names, everything. They evaluate the value of the whole hotel or a big data company. Then they say, according to our evaluation and risk assessment, we first underwrite. Remember this word. Underwrite that these assets indeed belong to you, this company. Because sometimes, like this hotel, they have some other parts of the assets belong to the other people. For example, at HKU, You know that within HKU, some of the buildings are not, or rooms are not belong to HKU, but belong to the HKU Student Association. Okay, you have to, they as the investment bankers, they have to specifically classify, okay, these assets belong to this company, and according to our evaluation, they worth this value, and this is a contract. And they use a lot of very complicated legal and financial documents to turn these assets into ownership contract. They say, okay, these assets are now owned by this company. Now we create the shares, also a lot of contracts of this company. Each share owns 1% of all of these assets. And they help the companies to sell these shares to, for example, if they divide the whole company's ownership into 100 shares, they sell 20% of these shares or 20 shares to the outside investors. They want to find out the investors to buy them, so they want to do some advertisement. Yes, selling companies also need advertisement. The advertising process is called, well, I leave this to you to search. Google. Although I cannot see you, but I don't want to tell every answer to you. Okay? This is very interesting. They make advertisements. The advertisement process is like, you give a presentation, you tell them like, okay, this company is really good, the shares will worth more in the future, buy them. Okay? This whole process. This is called investment banking. This is a primary market. But to attract the potential investors to buy these shares, the investment banks need to do another thing. That is, the investors will ask the investment, okay, if I buy your stocks, the stocks that you're selling, but if I don't want it in the future, are you gonna buy it back? Of course, the investment banks will not buy it back, but investment banks will say, okay, let us create a secondary market. That is the holders and potential buyers, existing shareholders and the potential buyers, to trade these stocks. So they create a trading platform. If the assets are being held, but the market doesn't have buyers and sellers, the market doesn't have transactions, we say this market doesn't have liquidity. If there are a lot of trading volumes, a lot of people are trading the stocks, we say this market has a lot of liquidity. Think about the water flow, liquidity, water flow. The stocks flow from one person, one holder, to another holder, and to another holder, to another holder. This is called liquidity. Okay, liquidity. So they want to create the liquidity. And sometimes the investment banks can perform as a, or the exchanges, stock exchanges sometimes perform as market makers. What are the market makers? Market makers are these market players, these people, or these institutions say, you want to buy it, but you currently don't have people to buy. You can buy the stocks from us. Why do we have the stocks? Because 2 minutes ago, some people want to sell this stock, but they don't have people. They can't find buyers, so they sell it to us. So the market makers are middlemen. The investment banks in these two divisions, investment banking and trading, they attract the intermediates. Intermediates are middlemen. Intermediates are called brokers. Okay, that's why they call broker-dealer. Brokers connect, or intermediates, they connect the buyers and sellers. Facilitate the potential transactions. Dealers are sellers. Investment banks first find out the potential sellers of their real assets. So they do a lot of things and say, hey, you have a lot of real assets, let me help you to turn them into the financial assets and connect you to the sellers. And they sell the stocks. Not only the stocks, they can also sell the bonds for the government or the companies. This is also their business. The dealers are sellers, but there are different sellers. The most important sellers are called, the biggest sellers are called primary sellers, or primary dealers. So for example, the US government is selling their bonds, treasury bonds. They can't say, okay, there are 12 million buyers. Let me talk to you one by one. No, they don't do this. They say this. There were 12 investment banks. Okay, you are dealers. Let me give you a good price, meaning low interest rate. Good price. Oh, high interest rate should be. Let me give you a good price. So I am selling these bonds to 12 of you. And you can distribute and sell to your customers. And your customers can sell it. So these are called secondary dealers, other dealers, third level dealers, fourth level dealers. So the whole process is like selling ice cream. You want to sell ice cream? You can't find buyers? No problem. You give me 1 million ice creams. I distribute 1 million ice creams to 2 potential sellers. And each one got 10 million. And they distribute to 100 persons. And they distribute. Actually, this is the same process as how you buy the things from the supermarket. Because the sellers also sell things to the primary dealers and other dealers, then they sell to the primary market. They sell to the supermarket. Okay. Well, some supermarket, they want to maximize the profit, so they minimize secondary dealers and other dealers, so they directly buy everything from the primary dealers or the producers. This is the same in financial world. If you want to get the best stocks, you don't buy it from the investment banks. You buy it from the companies. But the companies probably don't want to talk to you if you are not big. Okay, if you have $10 billion, yes, a lot of people want to talk with you. But if you have only like $1 million, well, the companies probably will ask you to talk with the investment banks. Or though, without investment banks, it's actually risky or dangerous for you to directly buy the stocks from the stock producers or the original companies, because you don't really have enough information of the companies. Yeah, you don't. They claim that these forests are their assets. You have no idea. Well, how do you know that the investment banks do not cheat you? Because they are regulated. If they provide wrong information, they will be punished. Okay. In Hong Kong market will be, as far as I know, one of the most rigorous and strict markets. In Hong Kong, no matter how big your this investment bank is, if you have one deal that you do not reveal all of the useful information, or you provide the wrong information, the Hong Kong Stock Exchange or the Hong Kong market will prohibit you to do all the future deals. And they require the person in charge, the person who's responsible for this deal, to sign their name. So if this deal got some problem, for example, the stocks get listed. The listed meaning that you create the financial assets as stocks, and you list the stocks to stock exchange, so the potential buyers, they can buy it from the stock exchange. Okay, there are some public offering or private offering. Private offering is like, okay, this company wants to sell 20% sales. I find two people, and these two people are really rich, so they can offer like $2 billion to buy their shares, and this is done. This is called private offering. But if, for example, Alibaba or Alipay, unfinanced, it's really huge. You can't find like 2 people or 20 people or 200 people to really buy these stocks. You have to find 2 million people to buy these stocks because the volume is too huge. So you need to list these financial assets to the public exchange. So then ordinary people can use their computers or cell phones to buy them, say, I want to buy. And if an investment bank help a company listing a stock and sell these stocks to the ordinary investors, and eventually the regulators find that the information provided by the investment banks have problems, then this investment bank, at least in Hong Kong, cannot do this kind of business anymore in Hong Kong. And also the person who signs the career of the person who signed the deal is over. Okay, he cannot do the IPO, at least in Hong Kong. They also have a lot of investment banks can do the first and second. Large investment banks also provide the third service, that is the analysis of the stocks. So they continue to provide the research of the stocks and make the ratings. Okay, because the future investors want to say, okay, you sell the stocks and you ask us to buy and sell the stocks, but we don't really know much about the company, and we don't have a lot of time and energy to investigate this company. And the investment banks say, okay, please buy our stocks, and we provide you additional service. We provide you the service, the research service. You don't have to do it. Okay. This is a result of competition between the investment banks. In the end, investment banks, they are companies. They are businesses. They want to make money, so they also compete. Well, there is another term I would like to bring up. Sometimes when an investment bank has a deal, say, okay, this company, say Alibaba wants to sell their stocks. I can help making all of the underwriting, check the background. By the way, the check the background has a term called due diligence. Due diligence means that you check everything, whether the information is real, whether the factory really belongs to this company, blah blah like this. But you find that you have a problem in selling these stocks. You have a list of all the customers, but this company's stocks were so much. They don't have enough money. Your customers don't have enough money to buy all of these stocks. What do? You find other investment banks. It's like, okay, I have a big asset. I can sell, but I can't find enough customers. How about this? You help me selling them and redistribute the benefits. This whole process is called syndication. Syndication. Okay. Syndication. The investment bank that lead the whole process, the most important one is called the lead underwriter. The lead underwriter. This is a sell-side investment banks. The famous investment banks in the European and US market include bulge bracket and boutique banks. The bulge brackets are the large investment banks. So they provide all of these three services. They include Goldman Sachs, GS, Morgan Stanley, MS, JP Morgan, Chase. Well, JP Morgan Chase is a result of the merger between JP Morgan and Chase Bank. In Hong Kong, you probably are not very familiar with this, but Chase is a very, very large commercial bank, kind of like ICBC. Okay, JP Morgan is more like an investment bank. Bank of America, Merrill Lynch. Bank of America is a commercial bank. Commercial bank does you give money to them, they deposit your money and give you interest or something like this. Bank of America, Merrill Lynch. Merrill Lynch was a investment bank, but in 2008, it faced a huge problem, a financial problem. So they were sold to Bank of America. Bank of America, Merrill Lynch, Citibank, Barclays, the largest bank in Britain, Deutsche Bank in Germany. By the way, currently, recently in the past 10 years, it's not really doing very well in the North American market, in the global market, about the investment banking business. But it's still a very, very large commercial bank. Credit Suisse is a Swiss bank, and UBS, also a Swiss bank. Okay. Of course, there are some other investment banks. HSBC, but it's not, we usually don't call it a bulge bracket. Well, the list changes. The list evolves. Maybe in the future it will be a investment a bulge bracket. We don't know. Some other banks, investment banks, they provide investment banking business, but they don't do a lot of other businesses. So they are called boutique investment banks. Boutique. Boutique means small but elegant. Small but elegant. Boutique. Jefferies, Rothschild, Lazard. Okay. And others. So this is about sell side. Let's take a break for 10 minutes and we will go into the buy side.